So my name's Asim Ali for some of the finance programs here at London Business School. I have the privilege of introducing our faculty here, Professor Naik. He's a professor of finance, joint chair finance faculty. He is without a doubt recognized as one of the leading experts in his field, and as a result, over the last decade, he has authored a significant body of work in the top finance journals, leading practitioner journals, and the financial press. Professor Naik's teaching includes strategic investment management program, equity portfolio management, and hedge funds. Since joining London Business School in 1991, Professor Naik has played a key role in the development of the finance group at LBS, most notably in the role of Director of the PhD program in finance, Director of the school's investment management program, and Director of the Hedge Fund Research Center. He's appeared many times on CNN, CNBC, Bloomberg, the BBC, ITV, and other news channels as an expert finance academic. He has consulted widely during his career for the World Bank, sovereign wealth funds in the Middle East, and private corporations in the UK, USA, Middle East, and Far East. Prior to studying his PhD at Duke University, North Carolina, he was working as a consultant for the World Bank and an executive for Special Steels and the Taj Group of Hotels. Ladies and gentlemen, Professor Naik.
Thank you, Asim. I imagine you can hear me. I'm taking this opportunity to take you through some of my recent research, which is based for long-only equity managers, based on their positions, their trades, and everything that they do. Rather than their monthly return or weekly return or a daily return, which is an aggregate of all the decisions that they make. So I would like to take this opportunity to take you through, and feel free to send in your questions via chat halfway through if something is unclear, or if you want me to go slowly, or there are any issues of any kind. My colleague is sitting here; she'll read out and kind of prompt me. So here we go. You have the slides in front of you. I'm just trying to get the next slide on. Okay, there you go. So the question we are asking is, are a famous investor like Warren Buffett and Wayne Rooney, I presume all the listeners are aware of these two guys, are they really worlds apart? Because both are superstars in their own worlds, highly rewarded, high achievers, and their fans, they believe they are highly skillful. Now the advantage of Rooney's manager is he has every statistic on him, knows where his strengths are, where his weaknesses are, while in Warren Buffett's case, we can only speculate on the source of his success. We have some idea, but it hasn't been possible to put him under the microscope in the same way as Wayne Rooney has been put, or indeed any sports person, may it be Sachin Tendulkar in cricket, or may it be somebody else in Andy Murray in tennis, and so on. So the reality is we don't know enough about the managers, what they do and how they do it, and that's changing, and I want to take you through some of the work that we are doing. So this is a typical analysis of Wayne Rooney's record. I don't want to go through that tournament when he was playing offense, passing, defense, etc. How many goals, shots, passes, all sorts, everything is analyzed. Yeah? And that's true for the World Cup cricket that is going on, which is one of my passions. And by the way, I support India. We have an outside chance, but they know everything about every player, what they do, how they respond, and so on. So what this has been hidden from the world of fund management. The analytical techniques we used in sports are now being applied to the world of fund management. I would like to take you through. I've teamed up with a practitioner called Rick DiMasio from Analytics. So he's been keeping this data with him and analyzing, together with a PhD student of mine, Anton Lines. He supports South Africa. I've asked him to change that, but we'll see. Okay, so I want to take this opportunity to take you through is the notion that both successful fund managers as well as successful sports people decide whether to buy or to sell, or for sports people to hit or to miss, or to and both are observable, both are measurable. So I would like to take you through as to what we do without further ado. So what do we have? We have 750 plus long only portfolios. So these are equity managers with benchmarks of, let's say, FTSE All Share Index or MSCI World or Russell or that kind, and I'll take you a glimpse of that. And covering a period from Jan 2003 till September 2012. We have the updated data as well because this kind of keeps coming in, but results are pertaining to this period. The advantage of this period is you have time when the equity markets were booming, 2003 till mid 2007 with low volatility. So it was a bull market with low vol. From July 2007 till about March 2009, it was a bear market with high volatility with all sorts of events taking place. Lehman, Bear Stearns, subprime crisis, and so on. And after about April 2009, it has been a sideways market with occasionally shocks coming from Greece and Cyprus and what have you. So we kind of are looking at the managers in very three different equity world environment, and the benchmarks against which they are evaluated are explicitly specified by clients, so pension funds, insurance companies, family offices, and the like. So these are institutional investors. And we measure their value added or alpha relative to the client specified benchmark, as well as what is used in academics quite commonly is the Pharma French 3-factor model plus momentum. So I'll kind of give you some idea as to what that looks like. And what we have is daily data, their holdings, so actually levels, the trades that they do, the buys, the sells, how they split it and all, their returns and their assets under management. So this is very detailed kind of huge large data set, and every day new information gets added of the decisions they made, the decisions they did not make or chose not to do anything about it. And so there are two types of portfolios. 618 are live, they are monitoring. So this is a large pension fund will say, well, here's a manager we've given mandate to, and I would like you to analyze and tell me how he's doing, what he's doing. And there are 135 selection portfolios. These are portfolios provided by managers to analytics. So there is some self-selection bias. Only the guys with good track record and a good fund will submit this information. So we kind of discount that to some extent. So you can think about the monitoring portfolio is like your behavior after marriage, and the selection portfolio is like your behavior before marriage. So clearly there is a difference. That's what my wife tells me. So I would imagine that I'm not unique in that. So what are the benchmarks? There are some 67 portfolios with US based benchmarks, 105 with UK, Europe 94, Japan, Asia Pacific, etc., Australia, South Africa, and the world. So it's very diversified one. Looks like I may have missed one slide. So let me just go back one slide and see. So this tells, yes, so one slide before, slide 8, I guess, is about what's the average duration, the history for we have. And as you can see, we have about, the median mode is about 5 years. So it's a long history for most portfolios. Some have longer, up to 10 years or more. And some managers are shorter. They have just enrolled into the program. So that's the kind of, it's a large enough sample to make statistically significant conclusions. So it's not by chance, but it's more something more systemic. That's what we can do. So that's where we are. Those are the benchmarks. Again, as you can see, US, UK, Europe, Japan, Asia Pacific, Australia, South Africa, emerging markets, and world. So this is, it's not like UK specific managers or US only. So it's a very diverse mix of managers operating in very different market environments, emerging market versus developed markets, and we do split it that way. So this one, the next slide is about a breakdown, how that has changed over time. The left side is a function of the numbers that we have, how that is broken down in US, UK, Europe, emerging markets, world, and the others. And on the right hand side, we have normalized to 100% and said what percentage of the portfolio that we have information for. How does that break into percentages, and it adds up to 100%. It's the same information a couple of slides ago, but to give you a more robust idea as to, well, the patterns are kind of They are not biased towards one market, and it's not changing a lot over time. There is some change as one would expect, but nothing kind of going from 0 to 100%. So that's where we are. So let's go to the next slide. So these are the managers, as we said, who have succeeded the beauty contest. So these have been shortlisted by Towers, Watson, Mercers, Russells, and the Worlds, the consultants, and then they are paraded in front of the boards of trustees of pension funds or decision makers and gatekeepers in other institutional investors. So we are kind of, these are creme de la creme. So we are looking at the Roger Federers of the world and the Djokovic's of the world and the Andy Murray's of the world and the likes. So clearly this is not the average, this is better, but if you're not happy with the top quartile or top decile performers, then we can you know what the others are likely to be. Okay, so what do we measure really? What we measure is how much do they deviate from the benchmark. So suppose I were to give somebody FTSE All Share Index or MSCI World as a benchmark. We know that if the manager were to hold the weights same as the benchmark, then you can't outperform the benchmark. With transactions, costs and fees, you will definitely underperform a little. So the only way the manager can outperform a benchmark is by deviating from the benchmark. So you will maybe overweight Vodafone, underweight Marks and Spencer. By the way, this is not an investment tip. This is just an example. So you have to deviate from the benchmark. So on the bottom half of the slide, it shows a 4-stock example. Suppose, hypothetically speaking, a simple benchmark is 50% in Tesco, 50% in Sainsbury's. So that's the kind of benchmark you are evaluated against in this small example to give you an idea what this active share is about. It says that if a manager is holding 50% Tesco and 50% M&S, clearly he has 50% overlap. So the first term is saying 50% Tesco minus 0.5, which is the weight of Tesco in benchmark. So that's a zero deviation. He's not holding anything from Sainsbury. So 0 minus 0.5 is about the manager holding 0 of Sainsbury. The benchmark has 0.5, so that's a deviation. And the manager is holding Marks and Spencer, which is not a part of benchmark. So the third term says 50% 0.5 in M&S and 0 in benchmark, which is an off benchmark stock. So you sum it up, absolute values, divided by half, so that it scales between 0 and 1. So 0 means no deviation from the benchmark. 1 means 100% deviation from the benchmark. That means you don't hold any stocks on any amount which are part of the benchmark. And these are long only, so there is no question of being short in a certain stock. So in the first example, you get active share of 50%. And in the second one, as you can see, the manager is holding 50% ASDA, 50% M&S. Neither of these stocks are part of the benchmark. So there is active share is 100%. That means you are deviating 100% away from the benchmark. So it's between 0 to 100. That's what you're going to see. So next one is we are trying to look at how this active share varies over time. And people use tracking error because they don't get to see the holdings. So the red dashed line is the tracking error, how it has varied in our sample period, average across the 750 odd portfolios. And of course, in the financial crisis time, the tracking error seems to have peaked. But if you actually look at the active share, how much are they deviating away from the benchmark? They have been hugging the benchmark or getting closer to the benchmark during the uncertain and volatile period, because as far as the manager is concerned, the benchmark is a risk-free asset, because no matter what happens to the benchmark, so far as my benchmark loses 20%, but if I'm evaluated against the benchmark and I lose 20% and some fees, I am not underperforming the benchmark by a large amount. So the absolute performance of the benchmark is a risk taken by the investor rather than the manager. So for manager, the benchmark is risk-free. And what this is trying to show is the correlation between tracking error and active share, which is on the right side, is very low, and at times it is kind of negative. That means high active share is negatively correlated with tracking error. So what it is saying is, and on the second part of the table on the right, number 2, it's showing that I'm using the mouse to highlight on the screen. The tracking error seems to be more correlated with benchmark volatility rather than the active share. The active share numbers are close to 0. Median is 0.1. I would imagine statistically indistinguishable from 0. And the active share on the left hand side, the black line, has kind of come down over time, and then as the volatility of the market has settled down, it has gone up to the original level. So that is on the left hand axis, and the red line dotted is the tracking error, and that is plotted on the right hand axis. So basically tracking error does not seem to tell you much in this particular case, and in terms of active share or the actual risk in the portfolio, which is the deviation from the benchmark as we saw in the example. So okay, you don't see my mouse pointer, so I'll have to kind of we'll try again. If you do start seeing the mouse pointer, then please highlight. Okay, all right, so that's where we are. Let me the pointer has arrived, and so on the previous one I was using, now the pointer has been frozen. It's okay, we will okay, so we just have to click it. Okay, and so this is the click what?
Just move.
Okay, click and then
click on this one.
Okay, never mind. I'll leave the mouse and the pointer out of this picture. That's partly because the mouse is very temperamental, and those of you who know about Hinduism, they have mightiest, the strongest god called Ganesha, the elephant-headed god, sits on the mouse. So just to keep it under control. So you can imagine what it means. Anyhow, so the summary statistic on slide 14 is about the different periods. What does their alpha look like? One factor is relative to the client specified benchmark. So it's about 1.5% in the first period, second period is volatile period is negative, and third period is picked up again. What you may find interesting is the average trades per month. So if you look at in the row on the left hand side, developed markets and emerging markets, the trades per month is about, the average is 51 in first period, drops to 38.8, which is about under 40 a month. So it's one trade a day or two trades a day. So these are not the guys who are kind of multiplying like rabbits, trading a lot. They think about it, and then they are kind of deciding what to buy, what to sell, and it's one or two trades per day. That's what they do. Emerging markets, again, we get to see there is higher alpha during the normal time, but it's more volatile as well. During the subprime crisis and financial crisis, they have lost much more. There's a lot of information there, I appreciate that, but it is just to give you a flavor of what they are doing. How much is their active share? It's about 70% for developed markets, a bit less for emerging markets. And it tells you what their tracking error is. And Herfindahl index is the sense of concentration in the portfolio. So the greater the number, the more concentrated the portfolio. Their turnover is about 140-150% in developed markets. So they turn their portfolio for every for $100 of this, they have $150 of trading on average per year. So that gives you some idea. Okay, so let me move on to the next one. So this is like in coming back to the sports analogy, in cricket it's like strike rate. So we are asking a question, we call it a hit rate, or baseball has similar, or basketball has similar. So for each trade, we can see when the manager decided to buy, whether it outperformed the benchmark or whether it underperformed the benchmark over the next 1 month. We also do 3 months, 6 months, etc. But I'll share you that. So idea is when we bought Vodafone, did the Vodafone outperform the benchmark? We do it both ways, relative to the client specified benchmark and relative to pharma French kind of benchmark, but that's a separate matter. So if it's outperformed the benchmark, then it's a hit. If it underperforms the benchmark, Vodafone underperformed the benchmark after buying, then it's a miss. And vice versa for a sell trade. You sold Marks and Spencer, and Marks and Spencer underperformed the benchmark, then it was a good decision because it added value. So that's a hit for a sell trade. And if you sold M&S and M&S continued to outperform benchmark, then it's a miss. And the hit rate is fraction of hits or the number of hits as a fraction of sum of hits and misses. So it's the same as strike rate in cricket or basketball or baseball. It just measures a directional aptitude, and we're introducing here to build an intuition to give you a flavor of where these managers are in terms of their skill measure, in terms of getting the direction right. Now, in an efficient market, 50% of the decisions will make money, 50% will lose money if you have no skill whatsoever. This is before transactions, costs, and fees. And if you had a crystal ball, or if you had a voice from the heaven telling you that which ones will make money 100% of the time, then the hit rate will be 100%. So if God were to tell you, or if a crystal ball were to forecast, or whatever you believe in, then it will be 100%. So the skill measure or the hit rate varies between, or should vary between, 50% to 100%. 50% means no skill in an efficient market, and 100% means you have perfect foresight, which clearly nobody has. Now, it's conceivable that the hit rate can be below 50%, because if you the ones that you get it right, make a lot of profit, but the ones you may lose money, they are smaller in size and you don't lose much. You can still be coming out profitable, but your percentage hit rate will be less than 50%. So this is like Shahid Afridi, Asim is sitting here, he supports Pakistan cricket. When he hits, he really hits. It's like Chris Gayle this morning. Not has scored a century since middle of 2013. But today he I don't know what breakfast he had. He had 215 of 145 deliveries. So that's they call it Gale Force today, because he's Chris Gayle. So it can happen that the big decisions that you made, there may be few decisions, but they make money. So I want you to kind of play this mental exercise for yourself, which is pick a number between 40 to 100%. 40 or 50 means no skill, efficient markets. 100% means crystal ball or forecasting ability, 100%. And just write it down wherever you are, and maybe you can put it in the chat line as to what your guess is, and between this, and then and my colleague here can do a little poll of it. So would you like to take 10 seconds to kind of pick a number? Efficient market, no skill, is Chetan says 75. Well done, you picked the middle number. Can we see some more? Okay, Manoj Harban, hi Manoj, is 50. Okay, 50, 65. Pooja 75. Devan 80, 70. Guys, this is incredible. I admire your optimism. All right, I think you guys have done a great job. Okay, so that's where you are. Now I'll tell you where the outcome is. How do I go forward? The slide. Oh, go back. It's smaller. Okay, all right. We've got an idea. So 50% is no skill, 100% is perfect foresight. And a number of you Yusuf Kolia has taken 50, Hassam is 55. Interesting. Okay, so let's say we also do some regression based model. So let's leave that for the time being. In the interest of time, I'll keep it out. But so the hit rate is here. Okay. So if I evaluate their performance just after the 1 month evaluation period, 51.2% of the decisions turn out to be, I can see Yusuf Kolia saying yay, or Hassam saying 55. Well, I was a bit optimistic, but it's so close to 50. And if you evaluate them over 3 months, 5, 6 months, 12 months, and 1 hour turnover, that's the holding period, it's tiny bit above 50%. Okay, and these are creme de la creme managers. So you can imagine, now you know why Larry Fink of BlackRock 2 weeks ago said active management is alive but not well, because when you pay the money and so on, you expect them to deliver slightly better results than but the active managers haven't, and these ones are no exceptions. Some of them are good. This is average, but average of top quartile, if I may say. And if I do the logic trade model, which I have not had time because it's a kind of a regression based analysis, but it's kind of showing positive and statistically significant. The logic there is larger trades. Do larger trades make more money? So that's the question. So if it's positive and significant, that means yes, indeed, larger trades make more money. So that's where we are. So there is some evidence of skill there. So let me go forward. So hereafter, so managers are better at anticipating the direction of stock prices. In the short term, slightly better 1 month, not so much over 6 months or 1 year. And the average is about 51%. The best manager that we in our sample had somewhere around 54%. And that is kind of the peak. And then there are some who are 48, 47. And then there are some managers who are good bull market managers. There are some who are bear market managers and so on. So let me go forward. Let me jump a few places and take you. We looked at persistence because people say that alpha based on returns in the past is not a good predictor of performance in future. And we asked whether our hit rate or the logit gamma coefficient, which is there on the slide, but we haven't had time to look at it, but it's the same idea. Do larger trades make more money than smaller? So we ask a question, is it persistent? Did the managers who had a higher hit rate last time, do they continue to have a higher hit rate? So in the sports analogy, it would be somebody who is in form. Okay, so it's a cricketer in form, or is it somebody who's playing well recently? Do they continue to play, and measured not based on returns but measured based on the percentage of decisions which make money, which beat the benchmark? So that's what we are looking at, and we find that indeed the hit rate based managers who are selected do better than regression alpha based one. So there is some merit to it, but there is a lot of noise. And the last part, so there is a little hope. It's not 100%, but it does better than looking at returns. By looking at how the manager is making decisions, what percentage they get it right. And the last one we do is the holy grail, is about predicting future performance. Alpha in future, so it's period t plus 1, is next period, and it's being predicted using skill measured at time t, that is using past history. The active share, so skill is like quality of risk taking, if I may say, and active share is quantity of risk taking. The both are important, and then some characteristics which is like concentration, turnover, number of trades per month, etc. So that's what we are trying to forecast. So this is for manager selection. And here is a table. I know there are lots of numbers, so I'll take you through column by column. And what it is saying is, if I were to use the first column is just the pass alpha, the adjusted R square, which is the bottom row, is 0. It has no predictive power at whatsoever. If anything, the coefficient is small, marginally negative, though statistically not significant. If I just use the hit rate, which is column 2, the hit rate has a positive and significant coefficient. So T stat is 3.5 and R square is little more than 0. There is a lot of noise there, so don't expect 100% kind of success rate here, but any improvement is a step in the right direction. Column 3, which is a substitute for 2, hit rate and logit, which is the do larger trades make more money, is same way. So they do a similar job, 6% versus 7%, 0.6 to 0.7% R square. Column 4 is active share, the quantity of risk taking, that also is related. And if when I column 5 is I'm putting together the hit rate and the active share, it increases to 9 instead of 6 or 7, which was in columns 2 and 3, R square, explanatory power. Column 6 is running a horse race between combining the quantity of risk taking, which is active share, with quality measured by the regression method. It gives you 0.1, the 10 is the units and adjusted R square. 7 is measuring, if I were to use hit rate, that is the quality, active share, which is the quantity, and then some controls, which is like concentration, Herfindahl index, or turnover value trades per month. It improves to 12. And again, hit rate is significant, positive, active, quantity and quality both are significant. 8 is just substitute, is same as 7. Instead of using hit rate, I have used the regression based measure, saying do larger trades make more money. It improves instead of 12 to 14 at the adjusted R square. So there is slightly better explanatory power between using the regression, but that's more complicated. And the last one is kind of a kitchen sink approach. You throw in everything and see what it does. So what we care about is the asterisk in the columns. So you realize that hit rate has lost its asterisk. So between logit model or the regression based method is supersedes the hit rate. But it's positive. So quality of risk taking is important for predicting future, as you will expect. And the quantity, which is active share, comes out significant. And Herfindahl index, which is the concentration, clearly the guys who are confident about their ability skill will run concentrated portfolios. So they're bigger bets, they have more conviction about, they will take on a big position, and that helps predict future alpha. So that's what they say. So it does better than the past returns based metric. So this is more about quality and quantity. And for those of you who saw the T20 World Cup 2 years ago, you saw that the skill was the highest of this is India versus Sri Lanka in the final, was Virat Kohli, but he was stuck. So the skill was there, but he was stuck at the non-striker's end. And Yuvraj, who was batting most of the time, where the quantity of risk taking he was doing, but his skill level at that time was he was a bit out of form, and we know the outcome. So it's important that the skill manager also takes on some risk in order to perform. So to conclude, this particular one, the trade-based skill measures are related to future alpha. Of course, there is a lot of noise, but it does better than using past returns. Between hit rate and logit model of skill, which is regression-based model, hit rate does almost as well, but it's much simpler. So if you want to take the easier option, then that's something that is easier to measure. Your administrator or custodian can work out very easily whether a buy decision outperformed the benchmark or a sell decision underperformed the benchmark 1 month's time. It's arithmetic. It doesn't involve any regressions or data or any such thing. And so that's something that one can do to evaluate a manager. Both risk taking, the active share, and the skill, which is the hit rate or the logit coefficient, regression coefficient, are necessary for positive significant future alpha. And concentrated portfolio is also informative about future performance in this particular regression. So I need to move to the next slide. I've successfully lost that arrow. How do I? Just a moment, please. And we are kind of coming to the last. Whenever this technology doesn't cooperate, I always tell my students, imagine or remember the universities which are currently in Pakistan, but northern part of then India, Mohenjo-daro, Takshashila, Nalanda, etc. There was no PowerPoint, there was no nothing, and they did all the pi and the time taken for Earth to revolve around itself and the gravity and all that stuff. So if the technology doesn't work, we should still be able to communicate. So with that, I'm happy to take questions, and please do send it via chat, and my colleague Anne here and others would kind of bring them up. So feel free to ask questions relevant to this or the programs that we have or anything else. Indeed, I can't tell you who will win the World Cup, but other things I can.
Narayan,
Yes.
multiple questions are coming in,
Okay.
so we will wait. They're typing at this moment. So Colin McCullough
Yes.
has asked, can you extend this to shorting? Seems like that's where the smart money might go.
Okay, thank you, Colin. We have in our sample only one equity long short portfolio by a very large hedge fund manager. It's a FTSE listed hedge fund manager, so you can imagine who it might be. But that they are looking primarily for better understanding of the mistakes that some managers may do. It's almost bordering on behavioral finance kind of issues, whether they run winners, cut losers, or vice versa, run losers, cut winners, and so on. So yes, the same logic applies to shorting, but we have a small sample bias of 1, but the logic applies, call it, to answer your question. Manoj, there are agencies. The analytics is the one which we have used the data. It's on slide 1, and they are, if you analytics, INALYTICS. If you put it on Google, but they will analyze for your own fund manager. So if you're looking at your company pension fund, then they will ask your custodian or administrator to submit the data to them, and they will analyze it for you. So it's a more customized one. Analysis. They will not tell you about manager XYZ managing money for ABC for British Petroleum Pension Fund or any of those. So you need to submit the data for long only equity managers, and this analysis can be done. Okay, so difference, Yusuf is saying difference between long term and short term. There's a typo there. As long as long term holding reduces costs. Yes. Clearly, the transactions cost is a concern, and what we find interestingly is their buy decisions are value adding. Their sell decisions, because these are managed portfolios when the new money inflows and outflows are not very on a daily basis like a open-ended mutual fund, but these are kind of come in maybe once every 6 months or once every year in a rebalancing. So their buy decisions is where all the effort goes in, and their sell decisions are actually to free up money for the buy decision. So it's more churning, not in a negative way, but because my money is fixed, if I want to buy something, I have to also decide which one to sell. So that's what, but they do care about reducing turnover costs. They do, if I break up the order, so if somebody wants to buy 1 million shares, they don't go like a bull in a china shop to buy 1 million shares. They kind of will start with 200 and then another 100 and so on and so forth. So we get to see their transactions costs and turnover minimizing strategies. And this analysis is after that they have optimized their analysis. Clearly, the 1 month doesn't take into account the long-term optimization that they may have done. But as you can see, as I mentioned to you, we have gone up to 6 months, 1 year, and their holding period actually. So yes, there is a difference, and it's partly from transaction cost point of view. Okay, how is this modeling would be help determining bid price for players during sports auctions? Saurabh, you're thinking about IPL and whether Yuvraj is worth 16 crores. Yeah, actually, just yesterday I was at Sloan Museum in Lincoln's Inn Field, and there was some analysis done by analytics on the seal breaking of oil seal in the British Petroleum case in the Gulf of Mexico, and they were looking at how these fund managers were responding to this news, because nobody really knew what is going to happen, and it's an analysis. I would imagine that analysis should be on analytics website, but what you will find surprising, Saurabh, is after that presentation there were 2 people from Team GB Olympics. Faz Ahmad, he is from northern Pakistan, Afghanistan. He is the coach for high jump. And Isabel Pooley, she won the silver medal at the Olympics. And they were drawing parallels between sports and for fund managers. Of course, there was no bid price for players during auctions. But I would imagine the same logic applies in terms of persistence in the skill. Skill will always be there, quality will always be there, form may come and go. So let me not say more about it. Saurabh, we have to have a drink and then chat about it, because it will go on till cows come home. Chetan, do you have view on fund focusing on energy market, current situation, doing geopolitical reasons affect the results? Chetan, I have a view, but I don't have time to go through that, so I will pass. Pooja, sorry, I can't hear anything now. Sorry, Pooja. Okay, it's okay now. All right, Devra, hi, Dhav. Good to see you're listening to me. Daily data is not freely available. Monthly data is available. And wondering if you or anyone know is this data is similar analysis or has it been discounted? Dhav, monthly data is difficult unless you at least have some decisions of the manager, because monthly data will be only returns. So you need something more than how the returns are put together. It's like in a car. If somebody says in an automobile, it goes from 0 to 70 miles per hour in 7 seconds. You will say, well, it looks like a petrol engine rather than diesel, looks like a 6-cylinder instead of 8-cylinder. So you have to a lot of guesswork you have to do. And this is before the electrical car Tesla came in, because Tesla can do that in 3.2 seconds. So you need to know a little more as to what is under the bonnet in terms of manager's quality or the decisions that the manager is doing. So that's where we are. Sorry, Chetan, I can't. It will take me a long time, but I have to hand over to Asim for concluding comments.
Thank you so much, Professor Narayan Naik. Hope you guys found that really interesting. And just to really conclude, as I mentioned in the introduction, Professor Narayan Naik teaches on numerous programs at London Business School. And we have one specifically coming up soon. It's called the Strategic Investment Management Program. Just to run you through when that program is, what the dates are. It's on the 20th to 24th of April. Program fees are £6,700. And feel free to contact me if you have any questions, if you'd like to reserve a place for that program, or any other questions that you may have. Here are my contact details. Sorry we weren't able to answer all of your questions today, but please feel free to forward them to me, give me a shout, and I'll be happy to help. Otherwise, thank you so much, Professor Narayan Naik, and
okay, I look forward to seeing some of you, receiving your questions, and potentially seeing you in April. Thank you.